Ladies and gentlemen, if you're standing by for Washington, our next departure will be the 2 o'clock, and it should be leaving at a C41.
Pardon me.
C41 and remain seated.
Oh, hey there. Great to see you again.
A little later with the seats.
Is this your first time flying Matty Air? First class here is nice. But you know what I prefer even more? It's called a direct flight. Flying these days is tough. Nothing gives me jet lag or like a layover in Atlanta. Layovers, they're just mishaps waiting to happen. They always seem to lose my luggage, extend my travel times on purpose. Very much like the mortgage business when they lose all your docs and make you extend your closing. Both are for the birds, and we know where they fly. Since we're here and it doesn't look like we're going anywhere soon, I thought this would be a good time to ask if you've ever heard of the term overlay. Sounds like a layover, an unavoidable checkpoint many loans need to pass through en route to their final destination, home to an investor. Now me, I'm all about direct flights, whether it's coast to coast or application to closing. And I got a lot of info for you today, so let's buckle up. The mortgage business and the airline business have more in common than it appears, besides the monkey business of losing your stuff. Have you ever been declined for some obscure reason? Your income's too low, your debt's too high, not enough reserves, too many reserves. Has your lender ever told you to just pay cash? Or how about that good old insufficient credit scores or simply decline because the underwriter says so? Nebulous to those in the business, but how does any normal human understand this jargon? If you ask me, I think a lot of underwriters spent their previous lives working for TSA, and perhaps vice versa. Seriously, after loans decline, your loan officer may be speechless. They just want to tell you that's how we look at these. No rational explanation. So how does a layover and an overlay relate exactly? Just like a flight from Phoenix to Miami, you could fly direct with Delta. Or you could take a budget airline, Frontier for example, and get to Florida from Arizona, but have to use Colorado as a pit stop. You know, a connection. Think of Denver as checkpoint Charlie, part of the path of the final destination, Miami. A lender overlay works the same fashion as part of the approval process to ensure proper delivery. To get closed, your loan must follow the path but also clear via the lender's method of evaluation. See, the ultimate destination for the majority of loans is with an investor, likely a GSE. Think of Fannie as your Loans Miami. But before you get there, the loan needs to pass through guidelines and also applicable overlays. Think of additional rules. Yes, in the loan business, there are rules set directly by the investor, also known as criteria or underwriting standards that your loan needs to remain within so that the investor will take that loan off the lender's balance sheet. Then there are lender rules on top of investor rules. Those are the overlays. So there's rules and then there are rules on rules. As underwriting goes, rules are known as guidelines and rules on top of rules are known as overlays. Furthermore, when you apply for a mortgage, lender overlays will differ from lender to lender. Just like Frontier flies Phoenix to Miami, but only through Denver. JetBlue may offer the same destination, but only through Houston. Each lender is like an airline. They have their own routes and policies. It's possible to have your loan underwritten by two different lenders using the same FHA guidelines, Fannie, Freddie, whatever, while also possible one lender may deny your loan while the other approve your loan. Most lenders will have overlays, but not all overlays are the same between lenders. First, understand that the mortgage business is that, business at the end of the day, and different lenders have different appetites for mortgage credit and manage appetite according to their risk tolerance. They can increase or decrease loan volume using overlays like the handle on a spigot. If more loan volume is necessary, lenders will reduce overlays, or inversely increase overlays to reduce volume, removing some risk. Lending is the risk business. Many people that use their primary bank as their lender of choice often get discouraged when their loan's rejected due to these obscure rules known as overlays. To take another analogy for coach class, Think you're in the American frequent flyer program and you've got millions of miles. However, you need to take a flight only offered by Southwest. Your mileage balance and status means nothing to Southwest, as it does with Americans, but that doesn't mean Americans going to fly you on a route that's not in their map. So, to get there, you got to fly Southwest, pay cash, and deal with their policies. Same principle if you got millions in the bank with Wells Fargo. If your loan setup is not in their playbook, they're not going to bend the rules just for you. All those deposits don't mean very much when overlays block your approval. Yeah, it doesn't seem right, but lending and deposit relationships do not always work hand in hand when it comes to agency rules and furthermore, restrictions from overlays. Sometimes you have to go Southwest, find an alternative route, or seek out another lender to match your loan request. I admit, banks do goofy things, very much like the guy at security wearing belt and suspenders, and certainly he's part of the problem holding up the line. Just because Fannie restricts or permits a credit, income, or asset feature doesn't mean that your lender is going to follow suit. When your lender says no to something that would otherwise be okay with the secondary market, they're using an overlay principle. Basically, they're saying, thank you, but no thank you. It's important to remember lenders originate mortgage loans for the purpose of generating fee income. While some lenders originate, others originate and service loans. There's a servicing value, providing additional income to the lender associated with the monthly coupons, believe it or not. But lenders don't make mortgage loans to collect interest on the money. If that was the case, it would bottleneck the lender's liquidity and decrease the viscosity of the mortgage market. Hence, the special purpose of the secondary market. It's the job of the secondary market to supply lenders with new liquidity. When a lender originates a loan, it provides interim financing for that loan through closing. After closing, the loan securitized as part of a mortgage-backed security, and the liquidity is returned to the originating lender. While at it, the secondary market provides standards and guidelines so that lenders automatically know what paper is safe to offload or what they would have to keep on their balance sheets otherwise. It's a symbiotic relationship that allows your lender to go out, find the next customer, and keep the money churning. Just because your loan meets the guidelines doesn't mean that your lender is entirely off the hook. There are practices referred to as buybacks where the investor could reject the loan post-closing and require the lender to take back the loan, hence the term buyback. When a buyback is involved, it requires more than the principal loan amount. It usually involves a penalty that could be several percentage points. Lenders are in the business to make money, not lose it. And overlays are ways lenders reduce their exposure to buybacks. Now, just because the seller servicer guide says a lender can make the loan doesn't mean that they always will. At the end of the day, it's the lender's call what guidelines they want to accept and those they wish to reject. Classic lender. It's not you, it's them. And just like the airline industry, lending sees a lot of mergers and acquisitions. Like airlines, lenders go belly up all the time. It's a tricky business to manage and very easy to mismanage. Now, back in the 90s, there was a lender, Champion, that had a famous tagline, when your bank says no, Champion says yes. Sounded like a wholesome proposition, but they said yes more than they should have. And that company went bankrupt. Sometimes you need to know when to say when, and that's why lenders use overlays. Now, banks are infamous for putting you on the wheel of misfortune when it comes to lending. It may appear that they usually say yes and only sometimes say no, or sometimes no, provided it's a Fannie Mae investor, and a maybe with a Freddie investor, or yes, but only yes if it's with FHA. All three of these investors have similar but different guidelines. Each investor has their own nuances, which may seem like splitting hairs. Now, here's an advantage of a big box lender because they usually will have access to all of them and be able to match your loan with the proper investor. But some lenders may only be set up with one of the three and therefore decline your loan because they don't have the relationship or the outlet of your loan. And since this plane isn't moving, follow this scenario. Guidelines for FHA loans may require minimum credit score of, say, 500 as long as you have 10% or more down payment. And let's just say, however, you bank with Jim's Bank, which also has a mortgage department. They're okay with you making 10% down payment for an FHA loan, but don't appreciate that your mid score is less than 600. So you need to think about how your lender's policy on credit score very much like your airline's policy on checked luggage. Your bags fly free sometimes on some airlines and others cost money, or free to cardholders or whatever. Jim's mortgage policy may restrict or deny your credit for scores above the FHA minimums because the risk managers at Jim's may show that if they're taking any new applications with credit scores less than 600, there's increased odds for delinquency. As a result, your lender may want to maintain higher credit standards and ratings to maintain better performance records with the FHA. But in doing so, Jim's Bank may refrain from taking on any extra clients that don't meet the internal credit score requirement. Think, you had the SATs to get into Princeton, but you couldn't make the cut at Harvard. If they do take on any new applicants with less than sufficient credit, and if it's not paid back on time, it could jeopardize the lender's, Jim's in this case, relationship with the FHA. So it's a two-way street. Think of the FHA as a lifeline for the lender to make loans. But if Jim's Bank continues to send the FHA clients that have a habit of slow pays or worse, default, the FHA may suspend Jim's from securitizing future loans. The FHA doesn't want to encourage lesser standards, although they do make the rules, but the lender doesn't want to have a bad report card. Regardless of the FHA, Fannie, Freddie, or Jim's mortgage bank, they all want the same thing, to see you repay the debt. They're not concerned with the equity in the house or how much you have on deposit with the bank, because at the end of the day, if you don't pay, those stats become a moot point. It's very important for you to understand that payments to the investor are due from the lender, whether you make them or not. Unfortunately, overlays will change from time to time. Last year, a lender may accept 620 as a FICO score for a program, and then this year make it 600. And then the following year, they may change it to 580 or increase it to 640. Sometimes they'll change these conditions based on pressure from the government to keep up with affordable housing goals. Sometimes it just may be the market and exposure in a particular region. It's about relationship management, and the lender needs their funding outlet more than they need your deposits or your specific loan. So it's a difficult balancing act, to say the least. So, do I have you thinking, do lenders publish their overlays like airlines do a flight map? Not really. First of all, there's thousands of them, and they're hard to uncover. Credit scores are fairly common, but it's not always limited to credit. It could be debt-to-income ratios, loan-to-value, it could be the amount of reserve capital. As the saying goes, you make your own money and you make your own rules. And it's important to remember that there are exceptions, and if an overlay is in the way, it could take a higher level of approval. In that case, your loan may be suspended until further review of your file or require documentation of additional financials to render a decision. Now, a likely alternative to a flat-out denial may be for the lender to make a counteroffer. An old example of this may be time needed for a new mortgage outside of a short sale. The investor may allow it after a week out of the event, but your lender of choice may require 2 years. Some lenders may just want to see time. Others may want to see time but document extenuating circumstances. A new world example could be from the pandemic, when the CARES Act allowed for people to not make the mortgage payment without penalty. Before taking a new loan, some lenders wanted to see repayment up of 6 months before extending any new credit. And some needed the back pay to be brought current. as restrictions changed, the Govy then amended what they would purchase from lenders, and then the market followed suit. Now, do I have you thinking, do all lenders have overlays? While it is common, some lenders do not oppose them and promote this as a reason to earn your business. While elective, there are certain risks, and which a lender can offset risk with higher rates or fees to compensate for the void. The significance of credit markets are that there are different types of risk. Think of flying coach, then flying first, or flying private. There are different classes, and each class has different costs. Just like a private jet can take you to any destination, a private loan can do virtually the same. Just understand that there are costs, and the choice is yours. And finally, here are my last thoughts. As always, shop for a loan and understand that overlays may be bank specific and not a representation of the broader mortgage market. It may help to improve your credit or financial picture, to strengthen your profile, and provide yourself with options. Not every lender is after the same client. So if you're not a match, it's not the end of the world, but an opportunity to start another relationship. Best way to understand what overlays there are is to complete an application with a credit check and discuss your plan of attack with your loan officer. A good loan officer is like a great travel agent that will help you with your qualifications, recognize opportunities, and help you make informed decisions, and to keep you from losing your marbles, aka luggage. Remember, just because a lender will deny a loan doesn't mean that you're forever restricted from obtaining the terms and conditions you're after. Likewise, just because another lender is offering you a loan that another will not, doesn't mean they're being nice. There may be an offset like a higher rate, or origination, or both to compensate the lender for the risk. The mortgage business is a highly competitive marketplace. And just like flights, you need to do your research and shop around. Every time you go back for credit, just like rates, policies will change, and it could be better or worse from last time. So that's all I got for now. Can you do me a favor and wake me up when we get there? Thanks.
Paging 1 aviation, say car to C31. 1 aviation, say car to C31.